to talk more about these details that have come out in the presentation, let's bring on board Kapish Jain, CFO at IIFL Finance. Thank you so much, Kapish, for joining in with us this afternoon on ET Now. It's a pleasure having you on the show. And let's talk
Pleasure is
about...
also mine.
Let's talk about, the RBI's policy that came in terms of that RBI has increased the risk weights. You've highlighted some bit that there is some marginal impact that is expected on your Tier 1 capital. But, going forward, what about your borrowing costs for you as well? How does that shape up as well? If you could give us more details on that front as well.
See, if I talk about borrowing, we are comprising of gold, which is one third of our business. Microfinance is around 15% and housing is around one third as well. It's clearly mentioned that for the housing finance companies, there wouldn't be any impact with regard to the change on any loan that they take. It's completely exempted. For microfinance and for any other lenders, if it's a private sector borrowing that they do, then again, the risks will not change. So for the microfinance entity also, the entire borrowing is private sector. So again, there's no impact. The impact that comes in is in the parent company of IIFL Finance, where we have around 36% of our borrowing, which comes from banks. And banks which are more MCLR linked, where the risk rates are likely to go up. So if you aggregate all of that, the overall impact is around 15% to my total liability, which might have an impact on the risk weight increase that banks are talking about. And as this comes out, whatever the borrowing cost change will come in, will have an impact. But the overall impact to that extent is very marginal.
Okay. So if you see, your yields have been improving, but in some segments like the affordable housing segment, the industry is repricing the loans lower. So how do you see your yields to evolve going forward, and what is your outlook when it comes to the net interest margins?
See, our yields have never been elevated. So if you compare to any of the other affordable housing players, they would all be in the teens or the mid-teens or the high teens range. So although we operate in a ticket segment which is less than 20 lakhs, which is largely the affordable housing segment, our rates are anyway very nominal. Our rates on the housing business is around 11 quarter. So that way, it really doesn't going to be too much of impact for us. And that's what is helping us to grow in a healthy manner and being able to protect our growth and our NIMs as well. So we don't really see any much of an impact with regard to pricing because it was never elevated at the first place itself.
Right. Kapish, you've also given that guidance yesterday in that presentation, and you've spoken about this before as well, about being able to grow at 25% till FY25. Now, what is driving this confidence for you that, about this growth rate, that this will sustain going forward, especially on a higher base as well? And how would your loan mix also change going forward?
So if you look into the period from fiscal 2019 to 23, we've been growing at a CAGR of around 23-24%. We have seen COVID, we've seen demon, we've seen all kind of challenges that the sector went through. But even then, we could sustain that growth. Now, if you see post fiscal 21, we have added close to around 1,200 branches. We moved from around 3,500 branches to around 4,700 branches, all India, pan India, which is the biggest distribution that we have done, which will enable us to get to the market where the growth can be built in through our distribution itself. And therefore, we believe that this growth is sustainable because India otherwise is really credit deprived. As you go deeper and penetrate into tier 3, tier 4 cities, the opportunity for credit is even higher. And with our presence of branches, we are a branch-led business model. We should be able to mobilize that business to sustain this growth. And that's exactly why we believe that we should be able to get to this growth number.
If you see your capital adequacy ratio, it is at currently 20% and you plan to increase it to 25%. So how do you plan to improve your capital adequacy ratio? Any fundraising plan going forward?
See, the opportunity for improving capital adequacy is there are various ways in which you can do it. As long as you grow with profitability, your internal accruals will help you and improve your capital adequacy positions. As you get more prominent and dominant into the segments where you're operating, you're able to then better negotiate with regard to your pricing at which you're lending out, which helps you in improving your NIM. And with scale, you get opportunities with optimizing your costs. That also helps in improving your margin on an overall basis. You would have recently noted that 2 days back, our outlook on our rating has been moved up by one of the rating agencies from stable to positive. That will also open new avenues for us to raise debt at potentially a lower rate as well, and also help us diversify our borrowing options. So both from a borrowing opportunity perspective, through cost optimization, and through dominance and margins expansion that we can potentially do, we would believe that we should be able to get healthy internal accruals, and therefore the number of 2,500 on PAT has been highlighted. This should enable us to have an improvement in our overall capital positions as well. So this is one important avenue through which we think we should be able to get to a much healthier capital adequacy position. Our net gearing itself on an overall basis is fairly healthy as well.
So I'm quoting here Jeffrey's report, which is saying that IIFL Finance could easily achieve a 24% EPS CAGR over FY24 to FY26. ROAs and ROEs can reach around 3.4% and 20% by FY26. So as per you, do you think this is easily achievable for IIFL Finance?
So, I wouldn't say, and nothing is easily achievable as long as you have a target which is really prominent for you. You need to really work hard. So we have really laid out the entire topography around it. We have our branches which is common. We've expanded our sales. We've identified our niche segment and product where we think we have an edge and we have a moat in which we can build ourselves. So with all those elements being put in, it's only about making sure that you're executing with clear focus. And with those things and all, we think we should be able to achieve this. It is never easy. It is not something which is of assurance, but we are fully geared for it. And I think our efforts and our expansion would help us to achieve those targets.
Okay, Kapish, thank you so much for joining in with us this afternoon on ET Now, giving us an understanding in terms of the growth outlook going forward as well, and about the changes that came in from RBI. How does that impact the company? Thank you so much, Kapish, for that.